Howdy there, folks. Welcome into the 3-for-1 here tonight. 3 videos to react to that I'm interested in giving my opinion on, hearing out what these folks have to say. Okay, stocks may fall 5 to 10% in the short term. Why are they going to fall 5 to 10%? And what's my opinion on that? Goldman Sachs is cutting their oil forecast by $10 to $100 a barrel. Now, I'm interested to hear this because, what I've seen on CNBC for the past 6 months is most Wall Streeters go on there and pump oil, no pun intended, and really just like massive belief that oil was going to keep moving up and oil and gas stocks were going to do great and those sorts of things. And what we've seen is certainly, at least in the price of oil, it's fallen quite dramatically over the last 6 months. And so interested to hear how they're kind of moving in relation to this whole situation, okay? And then this video is an important one I want to show you guys here today and react to this one, okay? What Disney could look at like in the hands of Bob Iger, not just from the standpoint of, I know there's a lot of folks that are looking at Disney stock, but this one's very important because that gentleman there, he's what you would typically call kind of like big money, Wall Street money, and hear how he talks about Bob Iger and how they view a situation like this, because it's important so we can kind of understand how a lot of these individuals, what the things they look for in a management team, right? And the sorts of CEOs that they want to back and where they want to put that money. So I thought that was just an important one that I want to show you guys here today because, yeah, it's something that's a very important subject, obviously, in the market management team. We all know that, especially over the past year, some management teams have come through and reported really good numbers and others just have, reported quite disasters, right? So I hope you guys enjoy this as always. Once a year, Black Friday sales coming up. To join the private stock group, get access to the private Discord chat, get access to all my different course curriculums and things like that. So our once a year sales coming up. If you want that deal shot to your inbox when it drops on Black Friday, check out pinned comment down there and we'll send it on over. Alrighty, let's get into this.
Jack, from your
Oh, and also thank you everybody that subscribed to the channel. 19,400 plus subscribers, if not 19,500 subscribers now. Appreciate y'all. Thank you for being subscribed to the channel. I'm glad you guys enjoy it.
Point over at JP Morgan, whether you do agree that there is going to be a trough further out in the distance before we get to that capitulation, after which perhaps you could get a more sustainable rally, but we're not there yet.
Yeah, I would certainly agree that the credit fundamentals don't really line up with what reality is showing us. I guess on the equity side of things, the silver lining here, the good news here, if you want to be sort of optimistic about it, glass half full, is that, well, a lot of what's happened this year, in fact, basically everything that's happened this year has been driven by multiple compression. So the good news going into 2023 from an equity market perspective is that stocks aren't expensive anymore, at least not in the way that they were at the start of the year. The problem, of course, is that earnings shoe has not really dropped yet, and the big question right now is just how bad are earnings going to be as we move through 2023. I don't think anybody is expecting good news from an earnings perspective. It's really just a question of how bad it actually is. But from that valuation perspective,
it was like true. I can't disagree with literally anything he just said there. I love trying to disagree with folks, but I can't find anything to disagree with there.
Multiple perspective, Lisa. That is at least one thing that's keeping me modestly optimistic about short-term equity performance potential.
And this sort of tension right now between valuations being low but potential outlooks deteriorating has been highlighted by a lot of Wall Street research, including Morgan Stanley's Mike Wilson, who just wrote, quote, "We still expect higher highs for this tactical rally." So that's the positive. Before the deteriorating fundamentals, that's the negative. Take us to lower bear market lows next year. How much, Jack, have we already seen, though, some of that disappointment bled into this last quarter's results, because there were a lot of disappointments and they were severely punished by the market action?
This whole year has been a disappointment. It's been an extraordinarily challenging year to be a strategist and try to figure out where things are going.
Preach. This year has been a big disappointment. Preach, baby.
For the short or medium term, because at every turn you are being challenged by something new. I could see another 5-10% lower on this equity market. I'm not particularly optimistic about this current rally. I don't really think it has legs. I don't think it has a whole lot to stand on. But I do like that valuation story, Lisa. I don't want to beat a dead horse here, but markets are off so much from where they were in January that I think if you extend your time horizon by more than 12 months and look out over 18, 24 months and beyond, the story starts to get a lot more interesting, because 2023 may not be a great year for earnings, but 2024 probably will be a pretty decent one. And if we can get over this trouble, if the recession that is coming ends up being shorter or at least shallow in nature, I think we can look beyond the short-term chop and focus in on that longer-term story.
Yeah, I think that's going to be a lot of the story, to be quite honest, in regards to the market in 2023 is going to be about recession, right? And I think that's going to be everybody's going to be talking about. 2022, let's be clear. Inflation that's dominated the headlines this entire year. And usually in the market, you don't get one subject to dominate the headlines for an entire year. But inflation has basically dominated the headlines, them tag team with the Fed. It's dominated the headlines the entire year, which is extraordinary. But I think 2023, it's going to be, recession. And everybody's going to be debating how bad it's going to get, where it's at, unemployment, all those sorts of things. So it's going to move to a very different conversation, and inflation will become a thing of the past. You'll forget all about it. Like it was a thing, like, oh, that's right. Remember 2022, it was like we had a whole year of inflation we had to deal with, right? 2023, that's not going to be the subject. It will be all around recession and debating like how bad it will be or not be, and those sorts of things. Okay. Now, Goldman cuts oil forecast by $10. Okay, not a significant cut, but it's a cut nonetheless.
Head of Commodities Research, Jeff Curry. Jeff, great to have you on the show. Let's start first with this report that you've just put out. $100 a barrel. That's still a lot higher than where we are right now. Walk me through it.
Well, our bullish forecast for 2023, really driven by the reopening of China next year. While the confidence remains high for that, the path between today and then, highly uncertain. Particularly given the rising cases in China, the big fear right now is a forced reopening, similar to what we saw in Hong Kong as well as Taiwan. The concern there is, right now, infection rates are at April 22 levels, where they were this last April when you lost 2.5 million barrels per day of demand. The fear is we do not know the policy reaction function. Caseloads go higher. The concern is they overwhelm medical facilities, and then you get self-imposed lockdowns and a collapse in demand. Now, while that forced reopening means a lot of pain near term, and as you reach herd immunity, you'd see a rebound in activity. And if we looked at forced reopenings around the world, it typically takes about a quarter before that activity really begins to rebound significantly. But at this point, again, I want to emphasize a lot of uncertainty. We still believe in the higher prices in 2Q of next year. But I think the key point here, why the viciousness of the downside right now, the trend lines have been broken. There was link to get rid of the market. The CTAs are short. All of that creates some tactical near-term downside risk. But I want to emphasize there's a lot of uncertainty. One last point on, OPEC. I think, kudos to OPEC for preempting this demand loss as the very first time in the history of OPEC where they actually preempted a demand decline, but I think there's a lot of uncertainty. Our estimates of the demand decline right now is 1.2 million barrels per day, not as big as what it was back in April. But at this point right now, it's about the same size as the OPEC cut. This is why we see it coming back up.
Okay, it sounded like he just made a statement for more negatives than positives, in my opinion. But I think I need to say this, okay, for everybody watching this right now. It's very important, is I do not understand the folks that are negative on the market and want to pile into oil and gas stocks, because that has been the common thing the past 6 months. At the end of the day, if you're very negative on what could happen with the economy, what could happen to the markets in general, I'm just telling you, oil and gas stocks have been proven out time and time again that if unemployment climbs massively, if the economy slows massively, it doesn't bode well for oil and gas stocks, and they usually do horrible. And we have two perfect time periods to look back at this, to see this, okay? Look what happened in the Great Financial Crisis. Prior to going into the Great Financial Crisis and prior to unemployment skyrocketing, oil was at insane records, all-time highs. And then what happened was by the time unemployment was climbing massively, oil price was down $30, $40 a share. Not down $30, $40, down to the price of $30 to $40. So WTI trading at $30 to $40. You saw this also in 2020. Guess what happened? Economy is going to slow massively. Unemployment climbs high, right? What's going to happen in that dynamic? Obviously, oil price is going to go down massively, right? So if you're very negative on this, what's going to happen to the economy over the next year, it's almost impossible. You're almost like trying to have something happen that doesn't happen, essentially, okay? Because that's just not the reality. The reality is if the economy goes like this, oil price goes like this. If the economy goes like this, then you have a good chance of obviously oil price doing very, very well. And in 2022, the unemployment stayed very, very low. The economy's kind of hummed along pretty decent, right? And especially in the front half of this year. Then you obviously had obviously Russia invade Ukraine. So all those dynamics all lined up, and you had an oil price go to $100+ in terms of WTI, right? And so the story made sense. If you're predicting that the economy is going to have a downfall and oil is going to go up in a significant way, that's just not playing a game of realities.
But I've got a little bit of whiplash here where OPEC's concerned, because we do have these headlines, and I know that they're meeting on December 4th, so soon. These OPEC headlines that the cartel could consider a production hike in December. Why? Why the change so quickly?
Well, the question is, how quickly of the pullback is. I think the key point there is what do we see happens with the G7 price cap? Because what we have seen right now, and part of adding to the downside price risk, is that the Russians are dumping a lot of oil on the market right now. And we look at inventory at sea, it's up 25 million barrels. So they're trying to get as many barrels into the market before the price cap and ban goes into effect on December 5th, which is, again, putting downward pressure on the market. Now, we only think...
You can have whatever opinion you want to have about Russia, about Putin, about everything like that, okay? But I need to say this, okay, because this is important for everybody watching this to understand, okay? The fact is, when Russia is a participant in the oil market, it's a good scenario, because what happens essentially is if you have Russia, you also have OPEC, and you have the United States. They're kind of competing with each other, right? Because they all want to kind of take some market share. They all want to sell as much oil as possible, but they also don't want to get too nasty where it creates some sort of epic price war, right? But at the end of the day, the more competition you have in the market, the better. If you suddenly take Russia out of the oil market, right? So now you kind of got like OPEC versus like the United States. And now it's a less competitive environment. When everybody's competing, what do we know about competition? The more competition there is, the more likely you're going to have prices go down. That's just the way it is. The reason... a plastic bag is very, very cheap is because you can get a plastic bag from anywhere. Like, it's a plastic bag at the end of the day, right? And so, why can you get a double cheeseburger at McDonald's for $2 or whatever, right? Well, it might kill you first off. No, I'm just kidding, okay? But in all seriousness, because there's a million other burger chains out there. And so McDonald's has to keep their prices fairly low. And if they don't, by the way, the double cheeseburger might not be $2 anymore at McDonald's. Who knows? With inflation, it's probably $10. I don't need double cheeseburger from McDonald's, but I don't know, okay? But nonetheless, there's only so much they can raise price because there's a ton of competition. Because there's a Carl's Jr., and there's a Wendy's, and there's a Burger King, and there's an In-N-Out, and there's this place and that place, and there's a Jack in the Box. So there's so much competition in the market, it keeps prices lower, right? So I just think that's very important to understand about the oil market in general. Having Russia in it makes it more competitive.
That's worth 300,000 barrels per day. So China worth 1.2 million barrels per day. The Russian excess supply being pushed on the market early worth 300. So the total hits about 1.5 million barrels per day. By the way, today, the market's pricing in a 2 million barrel per day hit, much bigger than that. But I think the key point is that once that oil pushes through the system out of Russia, that oil's at sea, you're going to start to lose another 300,000 to 400,000 barrels per day, which could leave more room for OPEC. But I think, the key point, that cut that they implemented in November equals about the offset loss in demand out of China. And there's a lot of uncertainty around how long that's going to last.
That's interesting. And gosh, man, China is so not predictable at this point in time in what's going to happen with their economy or not happen with their economy. And are they going to really fully open back up? Are they going to keep it closed down? Or are they going to open back up? And then, all of a sudden they get a bunch of cases and then they got to close back down. it's impossible to forecast what's going to happen in China over this next year. It is. It's just is. They're not predictable. They're not practical over there whatsoever at this point in time. Ever since Rona happened, I mean, it's ugly times ugly. Okay. Now, this video is very important, regardless if you're interested in Disney stock or not. This is a very important video to check out because this gentleman gives you some insight on like how this big money, this Wall Street money, how they think about management teams in something like this Bob Iger situation here.
The challenges that we've been talking about here that he will be facing once again. What do you think?
Good morning, David. Thank you for having me. I think that I really respect and admire Bob for his willingness to reassume this responsibility. There's a parallel here to Howard Schultz, but it's not quite the same. And I think it's great for the company.
That's exactly what I brought up earlier today. It's so funny.
And I think you have to at least respect the board for realizing they made an error in signing Chapek 11 months ago and in reaffirming that. And we feel a lot better about what's happened since last night.
Yeah, but it doesn't mean that the challenges are any less, in terms of dealing with direct to consumer, the enormous content costs there. Can you really make money? We were just having a conversation about sports rights and ESPN. What do you think when it comes to, for example, those two areas that Iger will do or do differently than Chapek?
I'm not sure, but I think that one of the things that there's a clue. We sent one of our best analysts to the Moffett-Nathanson conference this past week in California, and the surprise luncheon speaker was Bob Iger. And at lunch, he spoke about how much time he had spent in developing their franchise, their park business, and their film business in China. And since the change in management, Disney has not been able to get a film on in China. So I think the details matter, and I think that the willingness and the ability that he has to work with people, his historic ability to work with Steve Jobs, which led to one of the greatest acquisitions of all time, Pixar, his judgment and implementing probably what I think was I'm sorry, I'm losing my voice, the best acquisition of all time, which was Marvel. Details matter, and I think he's going to pay attention to these things.
Yeah,
details matter. So something I think is interesting here is I don't know how many people keep super up to date with the market, and shout out to you guys that are really up to date on everything. But I remember specifically, there's definitely some shareholders that were happy when Bob Iger left the company. There were some that were not happy. There were a lot that were happy. And the reason being is when he left a couple years ago, there was definitely, in terms of the company and the vision, there were some people that agreed with it. There were some people that weren't the biggest fans and thought the stock should be significantly higher than it was because Disney had already been kind of a stalled stock for a while. And now it's just even a stalled stock for longer. I think, over the past 5 years, if I recall, Disney's down. Like the stock price is literally down. So it's just interesting because I felt like it was a little bit of a mixed reaction when Bob Iger stepped down, a year or two ago, roughly. So interesting.
We know the talent matters too. And while Iger's coming in to maybe turn things around and make some changes, he's also coming in with a clock ticking. I wonder what your thoughts are in terms of the bench, what that looks like, and what succession, I guess, round two could potentially look like too.
Well, I think you draw the parallel to Starbucks once again. Howard is focused on restructuring the business and in finding the next CEO. And I think that's something that Bob is going to have to almost do from day one. He's probably, I think, going to have to pick a COO who people will see as his designated successor. And I think he's got a great bench. Now,
I have a weird feeling that Bob's going to be in this role for a while. I think a lot of people are thinking it's just going to be some short-term thing. I have a feeling it's going to be a while. I mean, if you're talking about the economy potentially, keywords potentially going into a major recession in 2023, and how all that shakes out, at the end of the day, with them losing a fortune on Disney Plus, And if the park business really started to slow in 2023 in a major way, which is a possibility, I mean, this was the revenge travel season, the revenge travel year, right? And if you're talking about a major slowdown in the economy in 2023, that's going to hurt the parks business in a significant way. Never mind, they just raised prices recently. So, I mean, he could have a whole different set of issues to work through and to try to figure out there, right? And I don't know, I just think those are factors to kind of keep in mind, and I wouldn't be surprised if he's in this role for way longer. I mean, way longer than anybody anticipates.
They lost a really talented executive when they lost Peter Rice, but they have an extremely talented, probably I think the most talented film entertainment executive in the business sitting at Disney, and that's Kevin Feige. And I think the thing you have to realize about Disney is that everything it does is entertainment. That's the parks, it's the movies, it's the merchandising. It's all focused on the value and quality of their superb franchises. They've created real estate value out of raw land in the center of the state of Florida because they're Disney. And you take that factor into account, I think that's what he's got to be focused on. I hope that answers your question.
Morris, if you look at the asset portfolio in general as it stands right now, is it what you'd want? Are there things to do in terms of...
I can't wait to hear his opinion on this, because at the end of the day, you look at Disney and you got to understand, this is a business all over the place. They have their parks business, right? Disneyland, Disney World, and all the international parks. You know that, right? On top of that, they have a huge licensing business. On top of that, they have, big screen movies. On top of that, they own a ton of basically cable networks that you can get on Fubo TV, the greatest service ever. Okay, they put on exclusive sporting events on their different channels. They also have things like Disney Plus, which has been their big kind of growth area, but also losing them a fortune. And they've even made some insane acquisitions, like the Fox acquisition a little while back. And so there's so much there with Disney that sometimes even as a shareholder, you start to kind of get confused on like, what do you own? And it starts to become almost a clouded picture, similar to like a Berkshire Hathaway or something like that.
Selling, buying, adding to, separating assets at this point, or is it just about maybe running them a little bit better and making sure that the relationships with content creators and distributors are better?
I think the answer to your question, Carl, is all of the above. Most important, Disney has the best entertainment franchises in the world. You can't replicate Marvel. You can't replicate Star Wars and the Star Wars universe. You can make them much better, particularly the Star Wars universe, but you can't replicate them. You can't replicate the animation library. You can't replicate the fact that people take their children to the parks to see the princesses. So I think those assets are extraordinarily valuable. And there's real estate now that comes around with it, the value that's been created as a result of that. But in terms of what you do from this point on, I think there's one issue that has to be dealt with. I think there's an opportunity here for your boss, Brian Roberts, and there's an opportunity for Disney, which is to restructure the relationship with Hulu.
Yeah, so, in regards to Disney, and this is one I'm definitely going to have to take a peek at in 2023, it's a confusing story, and that's the hardest thing for me when it comes to Disney, is trying to figure out, like each of these because you almost have to break it down business line by business line. You have to look at just kind of like the movie business, right? And even in that, you can almost split it between like animated movies and like the superhero movies and then like Star Wars. So, I think in the Hulu situation, then obviously they have all their different cable networks, which there's so many of them now at this point in time. They have the rights, right, in terms of selling rights to different cable companies and streaming services and things like that. It's a vast company that you have to kind of go through it step by step and break down all the business lines and then start to understand why this company should be valued at ... number. And I feel, my hunch is, and I'm going to have to do a lot of work on this beast over the next few months, but my hunch is Disney is undervalued right now, and it is a buy right now. But I'm going to have to do quite a bit of work there, nonetheless, over the next few months. And Bob Iger is going to have his work cut out for him longer than I think he is thinking going into this situation, and longer than I think a lot of folks are assuming. He might be there quite a while. Let's put it that way. Appreciate you guys joining me as always. We are now 19,400 plus subscribers at this point in time, approaching 20,000 subscribers. Thank you, everybody that's here for the reaction channel. I appreciate you all. Also, our once a year massive sales coming up for the private stock group and the Discord chat, all the course curriculum, stuff like that. So if you want access to that full deal, check out pinned comment down there, enter in your email, and we'll send it over as soon as it drops on Black Friday. Much love and have a great day.